Welcome and thank you for joining me here today for the January presentation, The Hart Act and the U.S. Exit Tax, a 2025 update. I'm Ashley Murphy, the founder and principal of Areté Wealth Strategists. We work with Australians in America and Americans in Australia to bring strategy, structure, clarity, confidence, and compliance to their global financial affairs and keep it that way. Some disclosures to make before we get into today's presentation include this does not constitute personal financial tax, legal, or investment advice. This is intended for general information purposes only, and essentially, unless you are a client of mine, then there should be no action taken from tonight's information. I should mention that, and it happens with every single presentation, someone will ask, hey, I can't make it. Is the presentation going to be recorded? Well, every presentation is recorded, and if you register, that we will notify you once the presentation is up on our YouTube channel. There are more than 50 presentations going back over the last 7 years on the YouTube channel, everything from issues to do with globally mobile individuals and their children, to the Social Security issues, to moving your retirement accounts, to prior updates on the exit tax. They're all there on the YouTube channel, so you're welcome to go check that out. I should mention I'm a proud member of the Global Financial Planning Institute. You can come here for finding advisors that are in the GFP community who have gone through a particular program, educating them on the issues that affect the globally mobile individuals. It's not very well known that the certified financial planning organizations and designations around the world are all very national in focus. And so the GFP Institute was created by me and my co-founder, Matt Gorin, PhD out of UC Berkeley, in order to educate advisors about what they need to know when clients' lives cross borders, clients' financial lives cross borders. So at Areté Wealth Strategists, here's an example of 3 broad types of clients that we work with. We work with clients who have a minimum of $1 million in assets that may be managed. An example here would be an Australian business owner living between the US and Australia, a high net worth Australian family currently living in the US, or an Australian executive and their family permanently relocating to the US. You can see a list of their goals and the outcomes, and the business has done very well. We're just in the process of transferring to SEC registration with $100 million in assets under management. So my experience in the cross-border world really came about from basically my life. So I'm a tri-citizen of the UK, US, and Australia. Grew up in Australia, did my undergraduate studies there, and as I mentioned at the very beginning of today's presentation, moved here in 2005. So it's been 20 years this year. And it wasn't until around 2008, 2009, I started with my CFP studies back when I was living in the Bay Area, and I began to inquire about perhaps whether there were books, groups, sub-chapters perhaps of financial planning organizations that dealt with international topics. And essentially I found that there was nothing, and eventually that's what led to the creation of the GFP Institute. Anyway, getting to tonight's presentation, I wanted to speak with you about something very exciting, the Residence-Based Taxation for Americans Abroad Act, which it should be making its way into the 119th congressional session. I'll talk about that very briefly. I was on a panel yesterday for the Democrats abroad where they were looking at this proposal, and I think it's very exciting, and I would implore you to do your bit to contact your elected representative to try and get some support behind this, because it's really only going to happen with bipartisan action, and quite honestly, it just makes all the sense in the world, as you'll see in a minute. So we'll talk about the Hart Act, a refresher there on what the HERO's earnings assistance and repatriation tax is all about. We'll talk about covered expats, downsides of being a covered expat, what is an act of expatriation, how is the exit tax calculated, and strategies to avoid or minimize the exit tax. All right, with that, let's get into it. So the Residence-Based Taxation for Americans Abroad Act was introduced in the 118th session by Representative Darren LaHood from Illinois, a Republican, And it essentially looks like this. Well, they expect it to be reintroduced in the 119th session, possibly with Democratic co-sponsorship. And essentially, it's what we've all been waiting for literally more than a century, something to do away with this citizenship-based taxation that otherwise afflicts Americans abroad. It would provide for a permanent election to terminate your U.S. tax residency and be treated as a non-resident alien while remaining a citizen. High net worth individuals would be subject to a departure tax on certain assets with unrealized gains and not at the Hart Act limits, which are very low, as we'll talk about in a minute. The limits that are initially being proposed are the unified gift and estate planning limits, which in 2025 is 13.99 million per person. So very high. That may come down a little bit. That was the scuttlebutt on the call due to what's called the Byrd rule in passing these laws. I won't pretend to be any kind of expert when it comes to how the sausage is actually made, how bills are actually passed, but it was my understanding that they need to be revenue neutral. I'm sure someone will write in with a correction on that. Needs to be revenue neutral, and so with the loss of revenue that comes from not taxing Americans abroad, which broadly is very unfair in the first place, but with the loss of that revenue, they may need to make that up somewhere, and the proposal is to possibly lower that limit from 13.99 to something less than that. Electing individuals receive a certificate of non-residency to prove that they're no longer a U.S. tax resident. That's very important in countries such as France, where they really don't want to have anything to do with Americans because of the reporting obligations that come with being an American abroad. Not such an issue in Australia. I personally have not encountered that, nor have I heard of any clients who have had problems with that. But the idea here is that there would be a registry maintained of individuals who have opted for this treatment. Electing individuals who move back to the U.S. would resume U.S. tax residency and be taxed as any other resident would be on their worldwide income. The bill contains a number of eligibility requirements and anti-abuse provisions. So this is it's a very new exercise for me because it's essentially trying to propose and gather support for a bill of a political nature, and we need to be mindful of how this might be twisted and treated in the media as some sort of amnesty for people that have not been compliant or a giveaway to the rich. And it is not intended as any of those things. It's to treat fairly the 8.7 million Americans that live abroad, of whom 2/3 have no U.S. tax obligation, but they must be constrained with all manner of reporting obligations and other investment restrictions that apply to Americans abroad, such as the passive foreign investment company restrictions. Someone just writes in here, Cass, good to see. NAB kicked me off their rolls when they found out I was a U.S. citizen. Interesting. I had not heard that from the National Australia Bank. So that's disheartening, but this would help you in the future. So as I mentioned, there's a payment of a departure tax based on lifetime gift and estate tax limits of 13.99 million, meaning if you've got an estate, if you're worth more than that, then you've got to pay an exit tax. Otherwise, you would not have that apply. Certification of the past 5 years of tax compliance, no different to the Hart Act, I might mention. Electing individuals are treated not as non-resident aliens and are therefore only taxed on U.S. source income, which is how the rest of the world works. If you announce, and Katrina just wrote in with a question, if you announce your citizenship, will this avoid this? Well, I don't think there would be any need, Katrina. That's the thing. I mean, we'll see what happens when if this does indeed come to pass, and this is a proposal at this point in time, Katrina. If this comes to pass, I think it takes away a lot of the need to expatriate in the first place. Shortly before that, Andrew asked, when will we know this bill has been passed in this session? Well, first it needs to be proposed, and first we all need to do our bit to contact our local representatives. I was just looking up who my local representative was, or confirming. I was pretty sure I was correct. It's Ilhan Omar here in Minneapolis. But I'll be reaching out and saying, yes, this is something you absolutely want to support, because you don't need to give up your citizenship if this comes through, because this would as you'll see a little bit further down here, this deals with many of the unfair things that come up being an American citizen abroad. So the closer connection exemption does not apply. Tax residency in a foreign country is required in order to be treated as a non-resident. How could you be treated as a non-resident if you were resident in the US? That it's kind of obvious. Federal government employees are ineligible. I don't know why federal government employees are always ineligible, but they are for some reason. The application of the savings clause in income tax treaties is waived with respect to electing individuals. This is gold, and this is exactly how I thought it was going to happen. This is the mechanism that makes sense, because remember, in every treaty every income tax treaty the US has with another country, they include right there at the beginning, they include this thing called the saving clause. And the saving clause essentially says that a US tax resident will not benefit from any beneficial treatment that may exist in this tax treaty, because the US will reserve the right to tax them as a domestic tax resident, thus nullifying any benefit that the individual may have obtained from that tax treaty. Roseberry writes in, who is the local representative in Georgia and California? Time to get on your computer and figure that out. There, I found there's a very helpful website that the government provides, actually, the US government, to very quickly answer what city you're in, and it'll tell you. Okay, a refresher. So with all of that said, we hope that this passes and we don't need to deal with the Hart Act. But in lieu of that, let's keep going here. Cass chatted in, so US doesn't tax foreign source income, but ATO still wants a cut of US income. That's true. Yep. So it gets a little complicated because it depends on the income source, but essentially, if one were to be receiving, like hypothetically, if one were distributing a retirement account from the US, that would still, because of the way the tax treaty works, that would still be taxable in the US and then taxable in Australia. But you're not double taxed, you're simply paying the higher of the two, which wouldn't be any different. That would be Australia. So not all that different in that particular circumstance. It's going to differ on an individual by individual basis. Pat Egan is joining us from Ireland. Good to see you, Pat. Or maybe you're back in the US. My tax residency is determined per the tax treaty between the US and country where I live. I file returns in both countries per no double taxation agreement, with foreign tax credit claimed on US return. My tax pro in US coordinates with tax pro in Ireland for my information. Okay, that's great. That's wonderful to hear. And of course, that's right. Your tax, just like anyone, your tax residency is determined. But the point that really underscores this, Pat, is that no matter what, no matter where you go, you will always be a US tax resident, and you're assessable on the US side, regardless if you're in Antarctica, Zimbabwe, or anywhere in between. And that's what the act we were just looking at is supposed to deal with. So the Hart Act, what is this? I misspoke. I said something different earlier. It's the Heroes Earnings Assistance and Relief Tax Act, was signed into law by President Bush in 2008 to provide tax and pension benefits to US military service members, which is why if you ever go looking for information about this online, at least half of the information is about being a beneficiary of this program rather than being a payor or avoiding being a payor into this program. The Hart Act brings significant consequences for US expats and resident aliens, i.e. green card holders who choose to expatriate or leave, giving up their citizenship or relinquishing their green card, and meet at least one of the qualifications that make them a covered expatriate. That's what we're here to talk about. So who is affected by this law? Well, really two classes of individuals, and I've mentioned them both already. One, US citizens who are giving up their citizenship, and two, long-term US permanent residents, also known as green card holders, who are the ones that are affected. Now, what's the definition of a long-term green card holder? That would be someone who has been in possession of their green card for or more than 8 or equal to of the past 15 years. And any part of a year is considered a whole. I had a joke with a client just last week. He got his green card in 2021. So we pulled out our trusty finger counter and realized that by 2027, December 31st, 2027, he's going to need to get out of the US. Otherwise, he's going to be deemed a long-term resident, and that's very bad news. And I joked with him and I said, in any part of the year, if the immigration official handed you your green card at the New Year's Eve party just before the ball dropped, wouldn't matter. The full year of the current year would count for the purposes of the green card. And he joked and he said, actually, we did get it on the 28th of December, and so we learned that the hard way. So expatriating, that's essentially that's a defined term to meaning relinquishing citizenship or officially surrendering your green card. There's detail here in this. Now, to surrender your citizenship is not a trivial thing. It's quite difficult to do. Of course, for both actions, for citizens and permanent residents, you must already be a resident of another state. Otherwise, you would be stateless, and that would create all sorts of other problems. The thing with the green card, however, is that it isn't merely letting it expire, such as if you're out of the country for as long as 2 years, that green card can lapse and be voided. That may affect your legal immigration rights back to the US. You certainly will find it will affect them if you try and re-enter on an expired green card, but it does not affect your tax status. That's done by submitting this Form I-407. And I'll show you that in just a second here. And I'm going to finish this slide before getting to all the chats and Q&A. It's a very lively topic, which I love to see. But some of the easiest advice that I have for folks when they're contemplating their tour of duty, their work life in the US, is if they're on a temporary visa, such as an E3, an L1, an O1, or any of the other ones out there, to simply stay on that. Because if you never start the clock running on your green card, you never have to worry about it. Now, that's very easy for me to say. In the previous Trump administration, I had a client who may well be on tonight's webinar who really got the rough end of this treatment when he found that the immigration services had been so depleted, so underfunded. Of course, COVID didn't help much either, but he couldn't get his E3 extended in time. And so it caused tremendous inconvenience to have to fly back to Australia, spend 2 weeks in quarantine, and then sit around in an Airbnb, not work, because that would have breached the terms of the E3 that he was seeking to renew. He then sat around for another 6 weeks before that was finally renewed. So if that's a situation that you might potentially be facing, then I could well understand that you might choose to go down the green card option and avoid that hassle and uncertainty altogether. Let me just look at the chat here. There's plenty of detail here. So Pat writes, yes, so that make sure you mention that Nadine writes that the Hard Tax Act was drafted by Charlie Rangel, who a few years after this got caught cheating on his own taxes with property overseas. Well, that is interesting. And it can be, Dean's right, that is true. It can be as little as 6 years and 2 days if someone were to get their green card on the 31st of the year, and then the very first 6 years later and 1 day, they would then be treated as a covered expat. Pat writes US domiciled but not resident. Right. Yes. So there's a difference in definitions here between I never said domicile, Pat. So just to be clear, so domicile is to do with where you see your permanent abode, where you see yourself, for the rest of your life. And facts and circumstances will determine that. I've done prior webinars talking about the difference between tax residency, estate tax residency, and legal residency. So 3 different definitions of that. So very good point to raise there, Pat. Thank you. Next, here is a diagram that I've created to really help us think our way through this. Just one moment. I realized I didn't get to the Q&A. So let's see here. Rosemary writes, who is the local? Yep. Okay. You can look that up. Katrina, if you take out money from a 401k in the US, when you are in the US and not in Australia at that time, and don't bring it back to Australia, and after 60, is it still taxable in Australia? Well, if you're in the US, then the answer would be no. So you would be purely a US tax resident from what you described there. It is the same as citizens of the US for under 8 years. Okay, that's probably in reference to being a covered expat. Actually, there's an exception. It's 18 and a half that you can get out and not have to worry about this. Okay, so let's run our way through this diagram here. So is the individual a US citizen or long-term resident of the United States? Yes. Did the US citizen relinquish their citizenship, or did that individual cease to be a long-term US resident? Yes. Have they met one of the three tests? We have not come to the three tests yet, but now is a great entree and opportunity for us to talk about that. The first one is what I call the net income test, the average net tax liability, not income, not how much money you made, how much tax you owed. And in 2024, that got up to $201,000. So by my rough back of the napkin math, because it's going to vary depending on someone's deductions, you're going to make pretty good money. So 650 to 750 for a single to married filing joint filer, depending on your circumstances. So you're making real money to fall into that particular test right there. The next one is a lot easier for folks to fall into, and that is the $2 million global net worth. Now, that is not indexed for inflation. It's $2 million. Now, in 2008, when this was written before the most recent property boom, $2 million was a different number. Nowadays, folks can easily have $2 million if they own a home, retirement account, a taxable account. Maybe they've got some stock options or something like that. Easy to do that. So, and remember, that's a global net worth. That's what you've got between the couch cushions. That's what you've got in your superannuation account. It's what you've got everywhere. Now, I mentioned super, but I'm going to come back and say something and be very careful about how I say it later. The balance of your super account is counted for the global net worth test, but for the purposes of the exit tax, in most cases, it is not counted, assuming you did not accrue any balance in that super account while you were a US tax resident. So I'll talk more about that later. The last one here is the individual fails to certify that he or she has complied with all US federal tax obligations for the past 5 years. Of course, we're in the business of helping our clients be compliant, so that's actually one that never comes up for us. Covered. Okay, if any of these three tests apply, if you meet any of them, bad news, you're a covered expat. And the bad news is not just bad for you, it could also be bad for your US citizen heirs. Two more questions have come up. I'm just going to take a look at those. Andrew writes in, is there a different net worth limit for married filing jointly? No, there isn't. Gets more complicated, actually, because now you're looking at joint assets. And if you're in a community property state, that can throw a wrench in things as well. Michelle writes, does cash count towards the global net worth? Everything counts towards the global net worth, Michelle. Yes. So Andrew, it's done individually, and then there's some accounting some creative accounting that can be employed to when there's joint accounts involved. Typically, it'd be a 50% balance, but someone might make the case that they contributed an asset that clearly brought that up. I don't know. I'm just saying that I have read about cases where people have made arguments for why a joint account shouldn't be treated 50-50. So here we are. The income test, average net income tax liability for the 5 years preceding the date of expatriation or termination of residency is more than $190,000 for 2023. This would suggest a pretty healthy AGI, as I mentioned. We're up to 201 in 2024. The asset test, more than 2 million, not inflation index. What is inflation indexed, however, is the $890,000 capital gain exemption that goes with that asset test. So if you had highly appreciated stocks, for instance, you've got $1 million of gain on your stocks, then when you exit, if your net worth was more than 2 million, you might well be a covered expat, but most of that gain is going to be exempted because you've got that $890,000 exemption amount there. And then, of course, as I mentioned, you need to file. You need to confirm that you've been compliant with your state and federal taxes on your Form 8854, which is the form that is the actual, form number that needs to be completed for an expatriation. Consequences of being a covered expat. Well, there's really two broad groups that are going to be affected by this. Of course, there is the individual, the covered expat themselves in the present time frame. They've got an income tax on exit. That's what we're here talking about tonight. But there's a sleeper provision, and that's Section 2801. This came in with the Hart Act, but there's been very, very little said, a lot less said about it than deserves to be said. And it's a sneaky little provision that affects the heirs of a covered expat. So for my clients, when I'm counseling them through this process, perhaps you have some dinks, dual income, no kids. They may not care if they're deemed covered expats. Maybe they have no exit tax or a very small exit tax. They don't really care because they're out of the system. They're done. They've paid their obligations and they're on their way. Whereas folks that do have kids, this can be a big concern, and it tends to sharpen people's minds and attention on the immigration status of their kids. Are the kids still U.S. tax residents? Because if they are, and the parents are covered expats, bad news. That means that the covered bequests or inheritances to those heirs of a covered expat will be hit with a 40% inheritance tax, and no one likes the sound of that. Trevor Carter writes in, is the 890,000 exemption per couple or individual? It's per individual. What is an act of expatriation? Well, that's fairly easy to define. Before I do, someone chatted in something. Tony, what if the kids are tri-citizens? Well, doesn't make any difference, Tony, unfortunately, because we really don't care where their other citizenship is. It's are they U.S. citizens, and if they're U.S., then they're caught in that dragnet that the U.S. runs globally. Okay, so acts of expatriation. U.S. citizens who relinquish their citizenship, typically it occurs via renunciation before a consular official. It's not something you're going to do accidentally. They cease to be a U.S. lawful permanent resident. Again, not something, well, you might stay out of the country for 2 years, in which case it could be accidental there, but you're not going to give up your tax status accidentally because that requires the completion of this form you see at the bottom of this slide here. So I've been saying that for years, and I think the message is getting out to the community that merely letting your green card expire does not count. You need to submit this form to end the tax residency side of your residency, the tax residency side of your residency. How the exit tax is calculated. Okay, this is what I think everyone's been waiting for. This is where we get into a lot of detail. There's not a ton of information out there on the internet as to how this is done. So I've done my best to make this accessible for folks. So there's 5 types of tax asset classes that we can think of. There's specified tax deferred accounts that includes IRAs, Roth IRAs, HSAs, 529 accounts, MSAs, medical savings accounts, to name a few. Eligible deferred comp. So in that category, you've got 401ks, pension plans, simple SEPs, to name a few. Ineligible deferred comp, mostly that includes vesting equity compensation, stock options, for instance, but it can also be 401ks and other pension type accounts that have failed one of the 2 tests that are needed for it to be deemed eligible. And we'll talk about that. Beneficial interest in non-grantor trust. So that's if you happen to be lucky enough to be the beneficiary of a trust that's paying something to you, then that's an asset that's also counted. And then you've got what I would call your capital gain assets, your mark-to-market assets. That's everything else. So keep in mind, the exit tax is not this monolithic tax. The language that's often used would make you think that. They'd say, oh, he got hit with an exit tax. Wow, don't want to get hit with that exit tax. Well, the way the exit tax works is they're going to divide up your estate and determine what falls under which of these categories. And then there's a different treatment that applies for each of these categories. And remember, the exit tax is calculated on your net worth, not your net assets. So your liabilities are reducing your assets to arrive at your net worth. First category here. So we've got specified tax deferred accounts. That includes, as you heard me say, traditional Roth IRAs, HSAs, Coverdell education savings accounts. Very rare to see Coverdells in this day and age. 529 plans, medical savings accounts. In my 15 years, I've actually Never, other than in a CFP study book, I've actually never ever seen a client who's got an MSA. They're as rare as crocodile feathers or hen's teeth. So I think this is one of the worst asset classes from the point of view of the exit tax. Deemed fully distributed. What does that mean? That means if you had $250,000 in an IRA, you expatriated, you completed your 8854, you went through the whole process. It's essentially like receiving a bonus check for $250,000 and then having to pay all of the tax on that. So the good news is that the account is stepped up. There's no additional tax to pay when you ultimately distribute that account. But that is a rude surprise because you're going to run through that progressive income tax scale pretty quickly if you've got some significant balances in your rollover IRAs. Okay, so that's everything we have to say here. So here's Kelly, a long-term permanent resident. How many years has she been in the US there for? This is a question. She's a long-term, it must have been at least 8 or more. She has a global net worth in excess of $2 million. She submits her I-407 and commences the process to formally surrender her green card. Great. Kelly has an IRA worth $250,000. Well, it's going to be a bad news day for Kelly if she didn't engage in planning ahead of this, because that whole account is deemed to be fully distributed and taxed at her marginal rate in addition to any other income that she had in that year. The IRA is not actually distributed, and there is a stepped-up basis provided to that, so she's not double taxed in the future. She would need to file the 1040 NR. NR for non-resident, that is the form name for the tax return, the U.S. federal tax return that's filed for non-residents, and pay the applicable ordinary income on the amount above her stepped-up basis. So we have a chat here. Peter, good to see you again. If you dispose of your primary residence in the U.S. before exiting, do you still get the Yes, you do, Peter, and you're getting ahead of me here, because that is one of the strategies: is take your capital gains deductions. Take your deductions. If you happened to own a primary residence and you did have significant gain there, then if assuming your tax filing status is married filing joint, then yes, you would take that $500,000. You'd sell that before your exit, and it's actually a known unknown. I don't know if you could use any additional gain and have that $890,000 mop up any other gain that you've got on the sale of your primary residence or not, but that is something I'm interested to find out about. Eligible deferred comp. So as I mentioned earlier, you've got your 401ks, your SEP simples, and employee pension plans here. To be considered eligible, they must meet two requirements. One, the payor is a US person or business. Second, there needs to be this form, a W-8 CE for covered expat, submitted within 30 days of the date of expatriation. Failure to do that, and you have just committed financial harakiri because you've turned what was possibly an eligible deferred comp account into an ineligible deferred comp account. And we're going to look at an ineligible account in just a moment. So the covered expat must notify the payer, meaning the custodian of this pension, of his or her status as a covered expat, and make an irrevocable waiver of any right to claim any reduction under any treaty with the United States and withholding on such an item. So that is bad news. They're going to withhold 30% no matter what. So if you exit, then there could be this issue to worry about, because they're going to take a flat 30%. Now, sometimes, in fact, perhaps even often, this is still preferable to the deemed distribution approach. And the reason why is because to take a flat 30% over many years could still result in a lower lifetime tax obligation on that asset, compared with if you had a $2 million 401k, for instance, or IRA. The tax bill, the effective tax rate on that is very likely going to exceed 30%, especially if you're in a state that has a state income tax as well. So if you've expatriated, by definition, going back to Pat Egan's point, you've changed your domicile, and even states that are as clingy and difficult to remove oneself from, such as California, which uses a domicile definition of residency. Even California would have their hands off you because if you're expatriating, it would be a contradiction in terms for you to somehow still be a resident of California, having given up your green card or citizenship. So next here, what are the different tax categories and how are they assessed? Next item is ineligible deferred compensation. I've crossed out foreign pension plans, and I alluded to that earlier. I'll address that in just a moment. But here we see some more sophisticated types of assets. So vested portion of stock options, stock appreciation rights, and RSUs. It essentially, you become ineligible if you fail to meet one of those requirements that we saw a minute ago. US payor and your failure to submit a W-8 CE to the payor of that pension. So that is going to be ineligible. And again, same treatment as before. It's essentially deemed distributed, just the treatment you don't want. So the reason I crossed off foreign pension accounts is for this reason, and that is there's a very clear exception that says that if the foreign pension, and I'm using the British definition of pension, which really they should update the dictionaries and change pension to retirement account. In the US, a pension means an income stream paid for prior work, whereas in the UK, pension could mean anything. It could mean a defined benefit account. It could mean a defined contribution account. It's quite ambiguous. In any case, the point here is if you have accumulated that retirement account while you were still a US tax resident, then it's going to be taxable to you at exit. But if you didn't, which I would say is the majority of the folks that I end up working with, they had successful careers in Australia or in Europe or wherever they were. And then they move to the US, things go well for them there. Maybe they meet someone, maybe they get a great job and they stay on, they get their green card, and then eventually become long-term permanent residents. Well, in that scenario, the foreign pension account would not count because they had accumulated that prior to becoming a US tax resident. Ineligible deferred income continued. Okay, should be included as normal income. It's exactly the same as I mentioned earlier about the deemed distribution. So James here, 42, a single Australian American dual citizen, has more than $800,000, or excuse me, has made more than $800,000 on average over the past 5 years. He's planning to move back to Australia and relinquish his US citizenship. He has a superannuation account with $400,000 Australian, that is 300,000 US, or less than 300,000 US, given what the exchange rate's been doing lately, that has been taxed as an employee benefit trust. That is not taxed on growth, but was accumulated critically before he became a US citizen. In such an instance, there shouldn't be any ineligible deferred compensation accounting for this particular superannuation account. It would be exempt. So just to say that once more, the superannuation account would count for the purposes of the global net worth test, but it would not be taxed in the event that it had been accrued prior to becoming a US tax resident. Beneficial interest in non-grantor trust. I can understand folks that get confused when you throw in this term non-grantor trust. Essentially, it means a trust that is its own taxable entity. If you are receiving distributions from such a trust, maybe your parents have a trust or grandpa established something and it just pays an annual amount. Maybe granddad's long since dead and this trust just continues to pay an amount, then what you've got there is a non-grantor trust, and 30% of the payments from those trusts are included, are taxable, not presently, but when received. It's very similar to the eligible deferred comp treatment that we saw earlier. As you see here, it's essentially the slide is saying exactly what I just said. Next, we've got Ken here, a covered expat. He's a 50% beneficiary of a non-grantor trust. Ken expatriates in November of 2024, just before receiving his annual trust income distribution of $100,000. Under the Hart Act, there's no tax due in relation to the non-grantor trust at his expatriation, but each $100,000 trust income distribution to Ken, including that 2024 distribution, because that came in just after he expatriated, is subject to a 30% withholding. Thank you very much, Ken. And lastly, mark-to-market assets. Peter Wakim, you're asking about residence here. We've got a fine AI-generated picture of a San Francisco residence. Covered expats may pay a capital gains tax on all other assets above that $890,000 exemption. It's as if they sold those assets on the day prior to their date of expatriation. Any gains or losses from deemed asset sales are taken into account in that taxable year. Tax rate that applies to capital gains above the exclusion limit is set at generally applicable U.S. tax rates based on the character and holding period of the asset. So, for example, if an actual sale of the asset would have resulted in long-term capital gains taxation, so will the deemed sale. So that's why I say capital gain assets, because almost everything else does have a capital gain type of treatment. I'm sure we could think of some obscure collectibles. There's one, they have a, who knew, right? Collectibles have a flat 28% tax due on them. So if you sold your Mona Lisa or your fine stamp collection or whatever, then that's subject to 28%. And that would be carried forward in this instance. So Jane here is a US green card holder and an Australian resident. She's been resident in Australia for the past 5 years. She has a global net worth in excess of $2 million. Bad news for Jane. Jane didn't do what Peter was suggesting earlier, and she did not sell her residence while she could have still taken advantage of that $250,000 primary residence exemption that the US offers a single filer. So she files her Form I-407. We know she's done. She's out of the US, the tax net, and all the rest of it. Included in her global balance sheet is an investment property of hers in San Francisco. Why? We just saw that a minute ago. She bought that in 2005, 800,000, and it's now worth 3 million. However, bad news for Jane here, because it wasn't a primary residence in 2 of the past 5 years, and the gain exceeds the threshold, which was 821, is now $890,000 in 2025. She'll have a taxable gain of 3 million minus 800,000 equals 2.2, 2.2 minus 821. She's on the hook for 1.379 million to be taxed at the prevailing capital gain rates. And worse, adding insult to injury, is the net investment income tax of 3.8% also applies in exits. So strategies to avoid or minimize the exit tax. Strategy 1, take your capital gain exemptions and your basis step-up opportunities, as rare as they may be. You'd be well advised to take them. So the first one is the $890,000 exemption. It's significantly larger than the primary residence exemption, and it also introduces the possibility of a staged exit. Perhaps you have a partner that is an American citizen, is more closely connected to the US through family or history or personal ties or whatever the case may be, and they don't intend on exiting the US. The other partner does. Perfect. So the partner with the higher balance sheet might look at progressively gifting or doing it all at once. They can actually use their lifetime gift exemption, assuming the spouse remaining is a citizen. You can gift up to $13.99 million in 2025 using what's called your lifetime gift and estate tax. It's a unified gift credit. Unified meaning for gift and estate tax purposes. So you could give that away to your spouse, and then maybe your spouse waits 5 years. There's a 5-year look back, so a total of 6 years. And in that 6th year, after they've gifted back to the spouse that has since expatriated from the US, then the second spouse could leave and possibly be under the limit as well. Now, that's very easy for me to talk about in a webinar. It gets quite a bit more complicated in practice. And the reason why is because now we have to worry about Australian titling of assets. And what we know about Australia is that there's no gift tax limit, there's no estate tax limit. Australia's got a very, very good PR program when it comes to these what are called transfer taxes. And that is, they sound good, the tax hawks and tax mavens out there, they say Australia is an example of what you want to do, no gift or estate tax. Not exactly. They just tax it differently. Every gift, even between spouses, between citizen spouses in the US, there's an unlimited marital gifting exemption. So Warren Buffett could give $50 billion to his wife if he wanted to, because they're both US citizens and they're married. However, in Australia, that does not exist. Every gift must be settled to cash. So if Warren Buffett were to, let's say he was an Australian citizen, maybe old Kerry Packer, if he had wanted to gift significant billions of dollars to his partner, I actually don't even know if he's married or not, to be honest, but if he had wanted to do that, he would have had to pay the capital gains asset. That asset would have had to be settled to cash before it could have been transferred. And this is where things get tricky on the Australian side, is particularly real estate. It's the iron glove. What is it? The iron fist in the velvet glove situation, where people don't realize, because there's no property taxes in Australia, possibly because there's no property taxes in Australia, they say, oh, well, I'll just retitle that house to my wife. Wrong. That's a dutiable event. Stamp duty payable, as we know, anywhere from as low as 3 up to 8%. So that could be a very, very expensive mistake to make, and which is why I suggest as an answer when people ask, when should you engage with planners? As early as possible, because the returns are exponential, because there's all of these things that you might not know about. Okay, so there's the primary residence exemption. I mentioned that a number of times. And then tax loss harvesting. This is really, really, really small, but any tax savings we can get for our clients, we're gonna work to achieve that. And there's an annual $3,000 loss that you can take against ordinary income. So we want to do that. The next slide is to do with progressive basis resetting. And what that means is, if you're in a lower income tax bracket, you can see what the applicable rates are. For a married filing joint filer, below $94,000, they're in a 0% capital gains rate. There might be an exception to someone's circumstance. Perhaps someone is taking a sabbatical. They're traveling around Australia, perhaps, and have very little earned income that year other than investment income. That might present them with an opportunity to step up some assets at either a 0%, depending on their income, or a 15% rate. And if they happen by chance to be residents of a state like Washington State, where there is a $250,000 tax that applies, well, above $250,000, there's a special tax that applies for capital gain sales, then that would be particularly attractive, in my viewpoint, to step up those assets if you have significant gain assets. Okay, strategy 2 is, I already alluded to this. This is the progressive gifting to a non-expatriating spouse. Unlimited marital gifting does not apply when you have a US citizen spouse with a green card holder spouse. The citizen spouse cannot gift an unlimited amount to the green card holder spouse. Instead, they may only gift $190,000 per year. Why is that? Well, Uncle Sam wants to make sure that he gets his fair take of that taxable asset, and so they don't want a permanent resident leaving and somehow they get shortchanged of their money. So there's a limit on that a citizen may gift a non-citizen spouse. And so I'm thinking of a particular client I spoke with last week. There's two actually in the same situation, where they have a net worth very much approaching $2 million as a married couple. So seemingly no problem. The problem exists, however, with the asset titling. Almost all of the assets are in one person's name, and so that presents a problem. If they're accreting $300,000, $400,000, $500,000 of income and gain on an annual basis, then it's going to be pretty quick before one of the individuals is a covered expat and the other one is not. And so what we're trying to do is levelize as much as possible, so that we can fill up the spouse with fewer assets in their name, to make better use of the $2 million exemption. And then there's a line down here at the bottom about 6013G, to do with taking that exemption, and that's to do with a non-resident alien still being taxed as a U.S. tax resident by choice. I did a whole webinar on that last year, so you're welcome to go check that out. There are a few circumstances where that could still make some sense. So in this example, Bob, a US citizen, is married to Linda, an Australian citizen. Bob's planning to expatriate from the US to Australia in 8 years' time. Very helpful. Yet again, the exponential returns on planning. Bob's net worth is 2.75, while Linda's is 300,000. By making annual gifts of up to 180,000 in 2025, Bob can gradually lower his net worth below 2 million. Now I say that ceteris paribus, Latin, all things being equal, there's probably going to be growth on those assets. So it may not work out perfectly, but it's going to extend that window of opportunity. And it may well be that Bob here decides to jump and move sooner if it looks like he's going to trip up above that $2 million threshold sooner rather than later. And he's going to be particularly mindful of that if he has children, and they're going to be subject to Section 2801 inheritance tax. Trevor writes in, given you're paying tax on 401k as it's distributed, can the 890,000 be used to offset that tax? No, it cannot. An early penalty. Well, I forgot to mention, Trevor, thank you for that. The early penalty is not applicable on the deemed distribution of those assets. So for Australian, again, I've done multiple webinars about this topic, but if you are an Australian tax resident only, then you can employ the tax treaty that Australia and the US have. Article 18.1 is the specific paragraph reference where you can actually distribute your account to Australia with 0% withholding on the US side, regardless of your age. So that's quite a nice giveaway that the tax treaty provides, but it's only to Australian tax residents. If you are a permanent resident or a dual citizen, then you're not going to be able to enjoy that. Taking the current favorable foreign exchange rate into consideration also. So the answer to the first part was no. Can the 890 be used to offset the tax and early penalty? Well, there's no early penalty, and no, it can't be used because it's a capital gain exemption, whereas it's ordinary income that's payable. So it's different types of taxes that are due on that, Trevor. Okay, strategy 3, gifting to an irrevocable trust. This is the strategy of choice of your high net worth and ultra high net worth individuals. So the idea here is that you make use of your lifetime gift exemption, the 13.99 million, you put it into an expatriation trust. You can say, hey, that's not my money anymore. That belongs to that trust. I may be mentioned as a beneficiary of that trust, but I don't control it. Australia sees through that kind of strategy, however. But for the US side, and that's okay because you're just paying taxes on as you would anyway on the Australian side. But on the US side, this is a legitimate strategy. This is what high net worth individuals do. They give it to their irrevocable trust, wait 5 years, submit their 8854s. They say, has there been any substantial change in net worth the past 5 years? No, because the substantial change was 6 years ago. We can sign that with a clean conscience and be on our way. Now, the drafting of this is very important because the giftor, the one making the gift to the irrevocable trust, needs to include themselves. They can't be the only person because that would be in breach of how these trusts must be written. But they might include a class of beneficiaries. They could say, oh, the spouse and children or the heirs of. Well, I'm an heir of, my parents. So are my kids. It's more than just me. So that's typically how you'd see the language of such a trust being written. Strategy 4, rolling ineligible deferred comp items into specified tax deferred accounts. This can make sense where the average tax rate may be less than 30%. So Jennifer here, a covered expat, she's planning to retire, renounce her US citizenship, and move to Italy. We just thought we'd throw in Italy for a change. Not everyone wants to move to Australia. Has a current IRA balance of 500,000 as well as 300,000 in her current employer's 401k plan, which importantly must accept rollovers. Not all 401ks do. Due to being a resident of a state with an income tax, Jennifer's current marginal rate is a combined 40%. So that's a little bit tricky, that example, because she couldn't actually expatriate while still being a resident of a state with a state income tax, because as I said before, that's kind of a contradiction. You must be overseas a foreign tax resident to be doing it. But I'm trying to make the point that if your distribution would cause a spiking of your average tax rate, then this is where taking that 30% could be beneficial to you. So by rolling her IRA balance into a 401k, she'll reduce her ordinary income tax by 10% compared to the rate that would have applied to the deemed distribution of her IRA funds. Covered expats. Okay, here we are in summary. So covered expats meet one of these three tests: the income test, the asset test, or the tax compliance test. Exit tax involves classifying a covered expat's assets into 5 tax categories that we just went through in detail: specified tax deferred accounts, IRAs, Roths, 529s, HSAs. Eligible deferred comp accounts, there's your 401ks, SEPs, simples, and pensions. Ineligible deferred comps, your stock options, as well as any item any retirement account not paid by a US payor or that did not have a W-8CE submitted within 30 days of expatriation. Beneficial interest in non-grantor trusts. There's the granddaddy trust that someone's receiving money from. There's a flat 30% withholding from that. And then mark-to-market assets with a gain exemption of, it's actually up to $890,000 in 2025. A variety of strategies may be employed to help reduce the exit tax, including taking the capital gains exemption, stepping up one's basis, progressive gifting to a non-expatriating spouse, gifting to an irrevocable trust, or rolling specified tax deferred accounts into eligible deferred comp accounts. Please join me next month. I think it's also going to be a huge turnout to give an update on Social Security for Americans in Australia or returned Aussies. The reason why is because the Social Security Fairness Act just passed was it last week? I believe it was last week. And so that has major changes to Social Security beneficiaries abroad where the windfall elimination provision will no longer apply. So that is very interesting indeed. There's actually a back payment for 2024 as well. So that's going to greatly accelerate the rate at which the Social Security Trust Fund is exhausted. And I think we're at time there, but I did want to just open up the floor and see if you had any questions, perhaps. Any ones that weren't already asked. Ryan asks, do non-US based assets apply with regards to the exit? Well, Ryan, I addressed that in the presentation, mentioning that they are included for the purposes of determining your net worth, but if it's a foreign pension you're talking about and it was incurred prior to you becoming a US tax resident, then that would not be considered. Anonymous writes, I am going to renounce citizenship. Is the $2 million joint or just my share? Just your share, but be mindful about joint assets. So typical accounting would be 50% would be what you would need to include there. The rate of there's a chat here. Hold on. The rate of questions is slowed down a little bit. So let me see what that. Thank you, Nancy. Always nice to have my fans. Frederick, good to see you. Mr. Eric Van Riet. So a U.S. citizen in Australia with kids in the U.S. should remain a citizen. I don't know about that. I think that's a jump. I think there's planning strategies to employ to. I think I would reword your sentence to say, U.S. citizens in Australia with kids in the U.S. should not be covered expats. That's how I would rephrase that, Eric. Andrew writes, can you repeat the part about penalty-free move of 401k to Australia? Would it be to an equivalent super? So, Andrew, there's so much to that. I've done whole webinars just like this, talking about this in great detail. So for Australian tax residents that have no US tax residency at all, this is typically folks that were in the US on an E3 or L1 or O1 or some temporary visa. They move back to Australia and they can invoke the tax treaty to get their retirement accounts back. The specific wording is deferred compensation items that were accrued in order of or for the purposes of retirement by virtue of employment. Words to that effect. That's not verbatim by any means. And so you're able to get your money back to Australia with zero withholding. In theory. The problem is in practice, many custodians, such as Charles Schwab, they've taken the view that they've got nothing to gain by using their brains and eyes and reading the tax treaty. And so they say, we don't care. We're not in the business of making those determinations. We're going to withhold 30%, and we're going to let you take that up with the IRS after April 15th, when you can file and get your over withheld amounts back. Either way, if you could get it back immediately, obviously that's preferable, but to get your 30% back upon filing your 1040 NR, that's still just fine as well. The Q&A seems to be filling up here. Let me see. So Rosemary writes, "What can I make? You certainly can. I've moved to Queensland. Well, it's just where I'm moving to as well this week. So, Rosemary, we've got a bit in common there. Tri-citizens moving to the same place. Please go to my website, Areté-WA or WS, Wealth Strategists or wealthaustralia.com, and click on the Get Started, and they'll just ask you to answer a few questions there. Anonymous writes, thanks, great presentation. Unfortunately, I tuned in late. Didn't I say, folks, didn't I say without fail every single time someone asks that? So, Anonymous, because you registered, you will get a copy, you will be notified when the when the presentation is up on YouTube. As for the slides, this is really just something I would share with clients, unfortunately. Victoria over here on the web chat writes, thanks for your presentation, very helpful. You're most welcome. Speaking of clients, I must jump to a client appointment right now, and see how I may be of assistance. But thank you so much. Please don't keep me a secret if it's you or someone you know that you feel my firm's services could be of assistance to. Then I would greatly appreciate an introduction. Thank you very much, everyone. Have a wonderful rest of your day.